Stop for a moment, because what comes next is not about charts. It is not about hype. And it is not about chasing a price on a screen. For years, silver appeared quiet, almost forgotten, while beneath the surface, pressure kept building, slowly, relentlessly. Not for days, not for months, but for years. Most people are watching the price. Very few are watching the system underneath it. And when systems fail, they do not warn politely. They do not move step by step. They snap. In the next few minutes, one question will matter more than any forecast. Why could owning just 1 kilo of silver end up separating those who prepared early from those who realized too late? Because the real reason behind that is not where most people are looking. Welcome to Boring Currency Reports. If you still believe in thinking ahead instead of reacting late, if you understand that experience matters more than excitement, then subscribe quietly, deliberately, the way serious decisions were made long before everything became noise. And before we continue, tell us in the comments, from where are you watching today? You watched the silver price the way most people did, as a number on a screen, up one day, down the next. Nothing that demanded urgency, nothing that felt historic. From the outside, silver appeared calm, almost boring. It moved, but not enough to dominate attention. It did not behave like fast-moving stocks. It did not attract headlines or excitement. For many decision makers, that silence became evidence that nothing important was happening. That assumption was the first mistake. Markets do not always signal change through noise. Some of the most important shifts begin quietly, hidden beneath familiar price ranges. Silver had spent years in that condition. It was traded, discussed, and dismissed using the same narrow lens, short-term price movement. But comfort in markets often signals risk. The issue was not where silver was trading. The issue was how it was being valued. Most participants looked at silver in isolation. They compared today's price to yesterday's price, or to an old high, and anchored their decisions emotionally. They asked whether it was too late or too early, as if markets cared about personal timing. They ignored relative value. Silver exists within a system of relationships. Silver against gold. Silver against stocks, silver against debt-backed paper assets. When those relationships are examined, a different picture appears, one that does not match the calm surface most people see. For a long time, silver was deeply discounted compared to gold. That discount became normal. Analysts adjusted expectations. Investors accepted imbalance as stability, but history shows that prolonged distortions do not disappear gently. They correct, and corrections rarely move slowly. Many professionals trusted price behavior more than structure. They assumed that if something mattered, it would already be visible in the price. That belief works in stable systems. It fails in systems under long-term strain. Silver sat at the intersection of multiple pressures: expanding money supply, rising debt, growing industrial demand, limited physical supply. None of these forces acted fast enough to create daily excitement. But together, they built pressure beneath the surface. Pressure does not disappear just because price ignores it. This pattern is familiar in business. A company can look stable while internal stress grows. Cash flow issues, balance sheet weaknesses, and strategic errors remain hidden until a single moment exposes them. Markets behave the same way. Silver showed signs of internal tightening even while the price remained orderly. Physical inventories shrank in key hubs. Premium stayed elevated during pullbacks. These were not signs of calm, they were signs of quiet absorption. Experienced participants recognize this behavior. Strong hands accumulate when attention is low. Weak hands wait for confirmation. By the time confirmation appears, the opportunity has already shifted. This is why silver's position confused so many observers. They expected noise first and meaning later. Structural markets work in reverse. Meaning appears first. Noise follows. Price breakouts added to the confusion. When silver moved above familiar levels, fear of being late set in. But price levels alone do not define opportunity. Some moves are arithmetic. Structural repricing is different. Structural repricing happens when an asset's role changes, when it stops being optional and starts being necessary. That shift does not begin with extreme prices. It begins with changes beneath the surface. Silver's behavior suggested such a shift was forming. For business leaders and young entrepreneurs, this distinction matters. The largest opportunities rarely look dramatic at the start. They look dull. They test patience, not courage. Most people miss them not because they are risky, but because they are quiet. The next phase was not about predicting an exact price. It was about recognizing whether a long-standing imbalance was beginning to correct, whether relationships were tightening, whether relative value was moving faster than headlines. Silver did not need excitement to matter. It needed recognition. And history suggests that once recognition begins, markets rarely offer long warnings. They were trained to watch the stock market, earnings, index levels, volatility. That was where attention naturally went. But the most dangerous risks in any system are rarely the loud ones. beneath the noise of stocks, beneath headlines about growth and innovation, sat a much larger structure holding everything up. Government bonds. Quiet, trusted, taken for granted. For decades, bonds played a simple role. They were supposed to represent safety, stability, predictability. They were the anchor that allowed the rest of the financial system to function. That role was now under strain. Governments across the world had accumulated obligations at a scale never seen before. This was not a sudden event. It happened slowly, year after year, justified by emergencies, stimulus plans, and political convenience. Debt became normal. Large numbers stopped shocking anyone. As long as borrowing costs stayed low, the system appeared manageable. That illusion depended entirely on trust. Bond markets are not emotional. They do not care about speeches or promises. They care about repayment, credibility, and confidence. When trust weakens, bonds do not panic. They slide. Quietly at first. That quiet movement is what makes them dangerous. Central banks understood this risk. That was why they intervened so aggressively. When bond prices wobbled, buying programs appeared. Liquidity facilities expanded. Language softened. The public was told everything was under control. But intervention itself was the signal. Healthy markets do not require constant support. When a central bank becomes a permanent buyer, it is not strengthening confidence. It is replacing it. And replacement only works as long as the illusion holds. There was a key detail many missed. Even after massive buying, bonds were no longer behaving as they once did. Prices did not rise with confidence. They merely stopped falling for a while. That is not stability. That is pause. In systems theory, pauses before failure are common. If bond prices drift sideways while support is extreme, it means private capital is stepping back. Investors are no longer convinced. They are no longer volunteering trust. That withdrawal may look orderly, but it creates fragility. A small change in yields can trigger large consequences. Higher yields increase borrowing costs. Higher costs strain budgets. Strain forces more borrowing. The cycle feeds itself. What begins as a technical adjustment turns into a credibility problem. This is why bonds matter more than stocks. Stocks can fall without breaking the system. Bonds cannot. Bonds are the reference point for pricing everything else. Mortgages, corporate loans, government spending, pension assumptions. When bonds lose stability, every calculation built on them becomes questionable. That is when liquidity disappears. Liquidity crises do not announce themselves in advance. They appear when sellers need buyers and discover none exist at acceptable prices. At that moment, assets that were once considered safe are sold simply to raise cash. That includes stocks, sometimes even gold, briefly. But what happens after the forced selling is what matters. When the smoke clears, markets begin to ask a different question. Not, what can I sell? But what can I trust? In environments where debt itself is questioned, paper promises lose appeal. Assets without counterparty risk gain relevance. This is where silver re-enters the discussion, not as a trade, but as a response. Silver does not depend on repayment. It does not require belief in balance sheets. It does not promise yield. Its value is not created by policy decisions. It exists outside the credit system, yet remains deeply connected to the real economy. For years, that position worked against it. In a world obsessed with leverage and growth, silver looked inefficient. It did nothing. It waited. But waiting is not weakness when the system around it becomes unstable. Many professionals made the mistake of assuming that if bonds were a problem, stocks would be the main victim. That assumption ignores sequence. Bonds crack first, liquidity tightens, panic follows, then capital rotates. The quiet risk does not scream, it shifts weight. As trust leaks out of long-duration debt, it must go somewhere. Some of it moves to short-term instruments, some to commodities, some to precious metals. Gold is the traditional refuge. Silver is the leveraged reflection of the same fear. This does not happen overnight, but once it begins, it accelerates. Confidence is slow to build and fast to break. For decision makers, the bond market is not a side story. It is the foundation. When the foundation weakens, preparation matters more than prediction. And silver, mispriced and underestimated, sits directly downstream from that reality. They had seen it before, and yet they always seemed unprepared. For long stretches, silver appeared inactive. It drifted. It hesitated. It tested patience rather than courage. To casual observers, it looked inefficient, even irrelevant. In a world obsessed with speed and innovation, silver's stillness felt outdated. But stillness in markets does not mean balance. Silver lives in a delayed system. Unlike financial assets that respond instantly to headlines, silver absorbs pressure quietly. It is mined slowly, often as a byproduct. Supply cannot be increased on command. Demand, however, changes with technology, infrastructure, and energy systems. That imbalance does not show up immediately on price charts. Instead, it accumulates. For years, silver operated in a structural deficit. More metal was used than was produced. The gap was filled by above-ground inventories. This process is not visible to most investors. Inventories decline gradually. No alarms sound. But once that buffer thins, behavior changes. This is when markets stop behaving normally. Silver's history shows a repeating pattern. Long periods of neglect are followed by short, violent repricing phases. These are often described as irrational or speculative. In reality, they are delayed corrections. Price is not discovering new information. It is catching up to old realities that were ignored. The reason silver moves this way lies in who controls it. During quiet periods, silver moves from weak hands to strong hands. Casual holders sell. Industrial users secure supply. Long-term buyers accumulate physical metal without urgency. This transfer does not push prices higher. It tightens availability. Tight availability changes everything. When demand increases even slightly in a tight market, there is no buffer to absorb it. Prices must adjust quickly to ration supply. That adjustment feels chaotic to those watching from the outside. But it is logical to those who understand the structure. This is why silver rarely moves in smooth trends. It gaps, it surges, it pauses. These movements are not signs of instability, they are signs of constraint. Another factor amplifies this behavior. Paper markets. Silver trades in volumes that far exceed available physical metal. Most transactions are settled without delivery. This works until too many participants want the same thing at the same time. When confidence in paper settlement weakens, even briefly, physical demand spikes. That is when premiums rise while prices lag. A contradiction that confuses many observers. They assume price should reflect demand instantly, but futures prices respond to liquidity, not scarcity. Physical markets respond to availability. When those two signals diverge, tension builds. Silver's catch-up phases often begin when that divergence becomes too large to ignore. Physical tightness forces repricing. Paper markets scramble to adjust. Short positions rush to exit. Momentum builds not from excitement, but from necessity. This creates the illusion of suddenness. In truth, the move was prepared over years. The spring was compressed slowly. The release feels fast only because most people were not watching the pressure build. Gold plays a role in this process, but silver does not depend on gold to explode. It depends on normalization. The silver-to-gold ratio reflects how undervalued silver becomes during long periods of neglect. When that ratio shifts, silver does not climb politely, it leaps. This behavior challenges traditional risk management thinking. Many investors expect time to react. They wait for pullbacks. They look for confirmation. In silver's explosive phases, confirmation arrives late. By the time consensus forms, availability is gone. Psychology compounds the effect. The first wave of movement is dismissed. The second creates frustration. The third creates panic. These waves repeat because human behavior does not change. Strong hands do not chase, they prepare. They understand that the most uncomfortable phase is the one with the highest asymmetry. Silver's delayed movement is not a flaw. It is a feature of a market constrained by physical reality. When it finally moves, it does not ask permission. And those who assume they would have time often discover that time was the one thing the market did not provide. They often thought in small units, ounces, coins, pieces, comfortable quantities that felt manageable and familiar. That way of thinking made sense in a stable system. But stability was no longer guaranteed. When monetary systems enter periods of stress, scale begins to matter more than precision. And this is where the idea of 1 kilo becomes important. Most people treat silver like a collectible, something to add slowly, something to admire, something optional. That mindset comes from decades in which silver played a secondary role. It was not essential. It was not urgent. It was not viewed as protection. That perception is changing. When silver is understood as monetary insurance rather than a hobby, quantity takes on a different meaning. A few ounces may feel reassuring. A kilo changes behavior. It shifts silver from symbolic ownership to strategic positioning. This is not about predicting a specific price. It is about understanding asymmetry. Asymmetry exists when downside is limited, but upside is not evenly capped. Silver's downside is constrained by production costs, industrial demand, and scarcity. Its upside is driven by repricing events that occur when trust in paper systems weakens. Those events do not scale gently. For business-minded individuals, this is a familiar pattern. Small exposure produces small outcomes. Meaningful exposure creates leverage, not financial leverage, but positioning leverage. 1 kilo represents that threshold. It is large enough to matter if silver is revalued as monetary protection. It is still small enough to be accessible. It does not require complex timing. It does not depend on constant monitoring. It simply exists as an option on systemic stress. This is where unit bias misleads people. Thinking in ounces makes silver feel insignificant. Thinking in kilos reframes it as capital. The difference is psychological, not mathematical. But psychology drives decisions. Another factor reinforces this idea. Availability. Physical silver does not scale easily. If demand rises sharply, supply cannot respond quickly. Mining takes years. Refining has limits. Inventories can only be drawn down once. When larger buyers move, they do not buy ounces. They buy weight. When markets transition from abundance to constraint, size matters. Many wait for clarity before acting. They want confirmation. They want consensus. But clarity often arrives after opportunity disappears. In constrained markets, waiting increases cost, not certainty. This creates an uncomfortable truth. Early positioning feels unnecessary. Late positioning feels urgent. The price of urgency is always higher. Owning 1 kilo is not a declaration that collapse is imminent. It is an acknowledgement that systems under stress do not unwind slowly. It is preparation for volatility, not a bet on disaster. There is also a behavioral advantage. Those who prepare early are calmer when markets move. They observe rather than react. Those who wait are forced into decisions under pressure. Pressure produces poor outcomes. Silver's role in such moments is not theoretical. History shows that when confidence in currencies weakens, tangible assets reassert their relevance. Gold attracts attention first. Silver follows with greater intensity, not because it is better, but because it is smaller, tighter, and more sensitive to flows. The sensitivity is what creates embarrassment for those who dismissed it. Silver does not need to become dominant to outperform. It only needs to be taken seriously. 1 kilo represents seriousness. It is a quiet decision. There is no announcement, no leverage, no dependence on institutions. It does not rely on someone else's promise. It simply exists. For entrepreneurs and business builders, this logic is intuitive. They understand optionality. They understand that resilience is built before stress appears. They understand that the most important decisions are often boring at the time they're made. Silver's current phase tests that discipline. The market will not tell anyone when it is too late. It never does. It reveals that fact only after repricing has occurred. At that point, headlines change, availability tightens, costs rise. What once felt unnecessary becomes urgent. The asymmetric decision is not about perfection. It is about positioning. 1 kilo does not guarantee outcomes, nothing does, but it shifts probabilities. It places the holder on the right side of a system where trust is thinning and tangible value is being reconsidered. In environments like this, waiting for comfort is a strategy. It is rarely a good one. Silver will move when it must. The only question left is who prepared while it was still quiet.